how corporations use cash value life insurance with better audio this time. So we're going to look at exactly how companies use these policies, which is high cash value insurance. That banking concept, the same thing that individuals can do, just seeing that corporate model, what the 1%, these big companies do from their side will help you see, okay, here's what they're doing, how do I copy it, right? That's what I want to do. I want to mimic the people that have money. What are they doing with their money? So if we take a corporation, they're going to take out life insurance policies. They can take them out on anyone. Here we're going to look at just their executives. It's typically on their higher level executives or employees. So we've got a CEO, CFO, COO. The company we've got here is the owner of the life insurance policies. So they have complete control over everything. So in the CEO, we'll say a premium payment, let's use $100,000 a year. Sometimes it's much more. Right, so if they pay $100,000 a year, it can be on each executive here, it doesn't really matter. The company is going to make that premium contribution. The company owns the policy. The company will have cash value positioned as an asset on their balance sheet, right? So the company can use the money however they want. They can use that cash value for the banking concept, borrowing and repaying. Maybe they're going to expand their business, whatever it might be. It's their money. The owner has absolute control. There is also a death benefit on each of the insureds. So let's say on the CEO, let's say it's $10 million, right? And this can be $1 million, it can be $50 million. The beneficiary of that policy is, guess who? The company. So you immediately get key man insurance, meaning if anything happens to Mr. CEO or any of the insureds, that death benefit flows back to the company. So they make the premium payment. It is not tax deductible, but it is liquid all the way through. That cash value is going to yield, what we always mention, anywhere between 4 to 6% high yield savings asset, tax-free all the way through, exactly what we want. Now, here's the catch, right? If I own a company and you're my employee, Cheyenne, right? She's my CFO. As the company, I say to my CFO, Cheyenne, if you stay with me until age 65, until 20 years, I, the company, create whatever type of vesting schedule I want. Right? This is not up to the insurance company or the policy. This is in the company's control. Let's just say age 65. Right? If you stay with me for the rest of your working years, once you retire at age 65, I'm going to pay you a retirement benefit. Call it a pension. Right? And I can say that's going to be any amount per year. And this is in addition to your 401ks, any other kind of income. Let's say it's another $100,000 per year. Right? From 65 to 85 until the day you die. Right? So you're going to get that juicy pension once you're retired. But here's the catch. If you decide that you're not going to stay at my company until 65, you decide to go start your own business, for whatever reason you leave, what happens is that retirement benefit goes out the window. So it creates those golden handcuffs where you feel, okay, I can't leave, because if I do, I have to walk away from this benefit. And the closer you get to retirement, the harder it is to leave. And then these plans are always set up where the former executive, the retired executive, is going to receive this income payout, but we're always designing them where a death benefit is still paid out to recover all the income payouts to that retired executive, meaning the death benefit is going to flow back to the corporation because they're the owner and the beneficiary. Quick side note I forgot to mention is that $100,000 that I pay the retired executive is tax deductible to the company as a compensation expense. So I cannot deduct the premium payments But as I compensate the retired executive, whether it comes from the life insurance, wherever it comes from, that is a compensation expense. Right? So I can write that off, and since I'm pulling it from my cash values, that is not impacting my cash flow, right? Whatever my business is, I'm driving returns, I'm driving in money. It's not coming from the cash values of the life insurance policy. So let's illustrate an example here. Let's give a quick tip actually, right? Because we hear so much about this bank-owned life insurance, which really started to take stride in the 1980s. An interesting statistic is when you look at bank-owned life insurance and policies that are on executives, the payout, this means money that when these executives die, most of them are retired now, but when they die, this is going to flow back to the banks. Right, so this has been the long-term play for banks, right? They've been positioning their dollars there as a tier 1 asset, goes nowhere but up. But when these executives eventually die, that's $400 billion, that number's increased, that's due to come back to banks. And guess what? What do the taxes look like on that? Tax-free, man. That's a huge number, $400 billion flowing back, right? So that's always been the long-term play with these insurance contracts. Let's look at some visuals here. So what we're going to look at, we've got a big funding number here, right? We're going to look at a 50-year-old male. We're going to see contributions of $500,000 a year paid into an account for a period of 10 years. Right now we can chop a 0 off or 2, we can add 1. The ratios are always the same. Why we use such a large dollar figure here is we did use a policy, it's a high early cash value account that's very cash rich from day one. In fact, you can see this here, where we pay in $500,000 the first year, and right off the bat, if you look at the percentage there, right, that's over 96%. For 50-year-old male plus an immediate $12 million death benefit. If anything happens to him, that's a huge death benefit that's going to flow back to the company. Right? So these accounts designed for corporations are often very cash rich up front. We're piling money into cash from day one, so we have access to it from day one. And this is money, again, because the company does what? They own it, they have access to that. It doesn't have to just sit in the balance sheet and do nothing. Let's continue on here. A little sloppy over there, that's all right. I don't know what's going on there, but that's okay. So as he pays into it, right, 10 years in, simple, we paid in $5 million. There's our cash. Insurance amount is huge. And then we've just got the basic returns here year over year. Let's get this out of the way. There we go. Right, so year over year, 5.5% tax-free. There are my cumulative returns factoring in the negative years. Again, we always mention between 4 and 6%. That's what to expect with these accounts. We see whether it's a corporate design plan or an individual plan we're designing for someone. These returns don't differ that much. So the returns are great here. What we want to look at though next is how do we actually use this? Look at sheet 2 here, which is going to display the same exact policy. We took off the returns. That's why we had the last sheet, because we don't need them in this one. But we're going to do the same thing we would do for an individual. Compare my account where I'm paying $500,000 a year for 10 years. There's my growth. Compare that to how the model would actually work. Right? So this is the company's plan here. Right? Keep that in mind. Let's just do it this way. Here's our payments. Here is our cash value. Break-even point just about year 3. Bullet points, company owns the policy, company pays the premium. Company controls and has access to the cash value. The life insurance goes on the executive at the company, has to go on an actual human being. Right? And the company, here's what we're going to look at next, pays the retirement benefit to the retired executive if he or she meets the vesting requirements. That's what the company is going to require, right? Then you get that added benefit. And the company is also the beneficiary, right? So here we've got our payments. They could keep paying in if they want. They let it stew for a little bit. And here's what we've got. We can make this income payout whatever we want. We just plugged it here from age 65 to 85. The company starts pulling out $400K a year and paying that to the executive. Right? They pulled out about $3 million more than what they paid in. Now, that's all well and good. One thing you noticed here that's likely different from what you're used to, or what you're used to seeing from us, from the banking concept and income scenarios, is this cash is still at a healthy level. Right? And why that is we're making sure the death benefit remains at a healthy level. Also, the cash value is accessible all the way through. I love this board. All right, there we go. So yeah, they're paying him income, but at the same time, if they need to access more cash, they've got access to that cash. That's theirs. When he eventually dies, let's say it's at age 90, guess what? There's $10 million of life insurance that's going to come back to the company 100% tax-free. So $400,000 per year was paid out. If we tally up the payments, it was about $8 million. That's what the executive received. Company still had access to that cash. He dies, company receives this, income tax-free. That $8 million they paid him was also tax deductible. Right, so you see all these benefits. That is just a basic overview of how income is actually provided to these retired executives. And again, company controls everything. The last thing we want to touch on here is the same income scenario, but we're going to look at loans, right? So when these policies are set up often, people think, okay, long-term plays to take income from the account. That's great. Here we're going to look at, all right, I've got my income down the road. We'll look at that in a minute. It's exactly the same. But the whole idea of the banking concept, right? I don't care if I'm an individual or a company, I'm going to leverage this as a line of credit. So here, I pull out $2 million, maybe just to expand my business, put up another building. Cash value is what? Line of credit. When I pull out $2 million, there's my death benefit collateralized, just like the individual models we look at. Continues to make that $500,000 a year contribution. And here we are going to repay the loan at $300K a year. Now, just like we would do for an individual, when it comes to paying back loans, you can do it however you want. You don't even have to. In fact, the income scenario that we'll look at, same as the last one, we don't have to pay it back. Or when we're pulling out income, loans are coming out too, which are withdrawals and loans. We're just not paying anything back there. So the main point here is when it is repaid, we see our cash value restored. Then we start peeling out income, $400,000 a year, just like the last scenario. So how companies do this is the exact same way we model this for individuals, just often larger dollar figures, and they're also using it as a retention strategy for their executives. Hope this helps.